Is it time to worry? It's been a difficult week for financial markets for 3 weeks in a row, with prices falling. The Fed does not rule out that price growth could resume. Indeed, just imagine what could happen if the fight against inflation suddenly drags on for another 3 to 4 years, as it has on average in the past. So far, however, the central bank has succeeded in many ways. Inflation rates have fallen, and the economy continues to grow, albeit at a slow pace. Hi, this is a quick review from Ivan Kompan, Edinburgh Business School analyst.
Retail sales are up, unemployment claims remain relatively low, and the industrial production index has unexpectedly risen, so it certainly doesn't look like an economic disaster. So, the Fed has the opportunity to put the brakes on even harder. And the markets, which have become accustomed to ignoring the Fed's threats, seem to be changing their minds.
It all started with the bond market. This is probably as it should be, as bonds are considered to be more smart than stocks, with much higher transaction volumes and fewer retail investors. So, this week, the bond markets are in a real tizzy. The yield on long-term US government debt has jumped to its highest level since 2008, in the UK it has reached a 15-year high, and in Germany it is at its highest level since 2011.
But the rationality of equity investors should not be underestimated either. When comparing the yield on risk-free government debt to that of the S&P 500, equity traders have concluded that the risk premium for investing in the S&P 500, which is now at a 20-year low, is too low to compensate for the risks involved. Consequently, they have no choice but to sell stocks in favor of bonds.
According to the Fed's research, there is a chance that the excess savings that U.S. households have accumulated during the pandemic will be exhausted in the current quarter. If the forecast comes true, consumer spending, which is one of the most important sources of economic growth, will also decline. It is likely that Americans will buy more with debt, which has already reached alarming levels.
So the markets are falling, but no one is in a hurry to buy at discounted prices. Stock prices have been rising since the beginning of this year. The S&P 500 by 15% and the Nasdaq by 30%, but corporate earnings continued to decline. This divergence could not last forever, given the nature and laws of markets. Now either prices have to fall, or revenues have to rise. That's just not how companies can improve their results in an environment of high interest rates, declining inflation, and tight credit conditions.
And finally, we would like to remind you that the information you have just listened to is not an investment advisory. Remember, investments in the stock market are always tied up with financial risks. So be careful and cautious. Like and subscribe to our YouTube channel. See you soon.